And also, we just wanted to use this as an opportunity to improve ourselves in the way we present these sessions in the future. So please bear with us as we go through that. The Q&A will be conducted through an online platform. I'll get Sally now to just introduce the platform and the event code for that platform. Sally.
All right, so I will be sharing the link to Slido in the Zoom chat. So if you click on the bottom there, it should say chat, and then we'll open up a box and the link is there. So all you have to do is click on it, and any questions that you have throughout the session, you just type it in, and at the end during the Q&A, I'll read out those questions and have Jay to answer them. Thank you.
Awesome, thank you very much, Sal. Without further ado, let's introduce Jay and Tien. Guys, take it away. You there, Jay?
Yeah. Good afternoon. Thank you, Abhinesh and Akash, for the opportunity to present to Data Ops audience. Good afternoon, everyone. And both my colleague Jean and I look forward to sharing our insights and a little bit details on our business and what we do. So by way of introduction, as Akash mentioned, we are a Sydney-based, analytics business, our client base generally originates from the asset management and asset owner segments of the financial services industry. So today's session, as Akash mentioned earlier, we will touch briefly on the business model and what are our sources of competitive advantage and how we bring data science into the complex problems that we are solving for our clients. And then, we will give you an update on the COVID-19 pandemic situation, touching on Australia and New Zealand predominantly, but also giving you a global context. Then we will move on to the economic impact and share some very high-level insights. Subsequent to that, I will touch on the markets and what's been the experience like and what type of sectors have been more deeply affected within New Zealand, but more broadly globally. So with that, overview, I'm happy to proceed to the next part of the session. So I thought, this quote from Warren Buffett was very telling for the current situation. I apologize, it's a little bit long. However, the gist of Warren Buffett's quote is that it's not so much the intellectual quotient that drives success for a lot of people in decision making, but it's really having a rational framework and a rational anchor of making decisions. And I thought that was particularly telling in the current environment where we are all bombarded with enormous amounts of information, often conflicting, and 80% of the time, the information is noise with very little insight for making decisions. And that, is exactly what, Foresight business model and Foresight as a business is about. Helping clients make better decisions using evidence-based database framework that has a rational framework around it. So we help our clients make decisions on evidence, not on emotions of greed and fear or euphoria or despair. And in current environment, I think this is very relevant given the situation we all face and all businesses are under threat, our jobs are under threat, and our livelihood is under threat. And it is important that we focus on the real insight, the facts, as opposed to information that is noise and doesn't add to our decision success. So as Akash mentioned, we are a data-based company. At the heart of what we do is really a optimal combination of bringing human perspective, bringing data-based insight, and using technology to make it scalable and repeatable for our clients. And that is sort of at the core of our business. And that robust infrastructure data technology setup has allowed us to pivot our business into areas like COVID, which is not a traditional space that we would operate in. However, the complex nature of this crisis, which really originated from the health sector, if you like, rather than a financial sector, that health crisis became the causal factor for economic crisis, and as a result, financial crisis. So we had to pivot our capabilities and our data science skills to really understand what was going on with this pandemic, and be able to provide insights that were relevant for our clients. So we were able to very quickly launch our modeling on COVID in March, which we will give you a bit more details on, and Jean, my colleague, will speak about our process there. So using the human insight technology and data science, we solve complex problems. And it is the evidence-based framework, bringing well-rounded perspective of various types of information using technology in a scalable way, allows us to provide provide insights that are very valuable, both from understanding what has happened and why things have happened, but more importantly, what is likely to happen across economies and markets and so on and so forth. So briefly, in terms of our specific services, there's a range of things we do, and I don't want to spend time going through these. We will share the slide deck for your benefit in due course. But suffice to say that, in the first quarter of this year, and particularly over the crisis period, we have been very busy, providing insights and analytics around market risks, and market stress testing and portfolio stress testing. Now, that is something that is a core skill set, and we bring data science and other kind of tools and analytics to the fore. But as the market started to crash, as the pandemic had more and more widespread damage, asset owners, superannuation funds, and our clients wanted to understand where their portfolios were sitting, how it's likely to evolve, and what actions they need to take. So we've been particularly busy on that front, but of course we provide ongoing global economic and market insights to our clients, including strategy formulation and asset allocation, some of which, some of the insights from our work in that space will come out during the presentation. Just briefly, as Akash mentioned in the introductory piece, we do serve a number of clients in Asia Pac. Many of these are, domestic Australian-based asset management firms, but quite a few are from Asia and global names such as Fidelity and so on and so forth. The reason they come to us, for the complex type of solutions is because, we have global best practice in the way we define problems and we solve problem, and we then, provide an ongoing managed service to these clients. So we're very pleased to have a diverse group of clients that have supported us over the last 5 years and continue to support us during these volatile times. With that note, I will hand over to my colleague Jean, who will give you a overview of the data science process at our firm, and share some insights on the application. I do note that a number of our audience today, a number of you there on the call are from data science perspective. So I think you will enjoy this session with Jean.
Hello, everyone. Welcome to this webinar. And so here we've got the application of data science, kind of like the spinning wheel on the left-hand side, which we have the overall process. I think most of you would be very familiar with. in the data science space. So we first need to define the problem and then go through a number of steps until we can train the model and finally create some products which we can deploy to our clients and get insights from that, and also repeat the whole process. And so to give you some flavor of the projects that we've been working on the right-hand side, we've got a few flagship projects, for example, the economic modeling project, and as well as the capital markets modeling, and finally the credit risk modeling. So each project has their own specific data science journey, and I wish I had time to go through all of them with you, but but for example, for the credit risk modeling, we use machine learning to separate good loans from the bad loans, hence minimizing the risks exposed by the financial lenders. And specifically, we predicted the probability of default for each observation. For example, each client will have a certain profile, for example, where they live and their postcode and their information, their transaction information, and all that dynamic information. So the outcome or the goal was to predict the probability of default for each observation. So along the way, we had to solve problems such as the high dimensionality, imbalanced data, because as you know, not many people cannot repay their loans. So we had a very highly imbalanced data where majority of the data are good loans. Only the majority people fall into the category of bad loans, or that they default. So yeah, many of these aspects are not uncommon in data science projects, and which we apply to all the relevant projects here. And it is a journey of finding the right balance between accuracy and practicality, and between overfitting and generalization. So to give you a flavor on the model construction, here we have a snapshot of the economic impact project. For example, on the left-hand side, we have a number of economic factors or indicators. For example, the demand and supply factors. As we know, the oil prices plummeted in the recent months. And so another indicator, for example, services and non-services, private and public investments, export and export. And all these factors do feed into our model. So we have a very large data set to start with. And our goal was to predict the economic regime, which Jay will give you more perspective on this when he touches upon the project of economic impact. So yeah, the goal was to predict which state we are in terms of this economic regime based on inflation and GDP growth. So once you have those states being predicted, or you know where you are, we basically use this information to guide us through the asset allocation process so that investors can make reasonable choices or optimum choices on asset allocation. So one of the key aspects in dealing with such data set is about how to use all these data sets and make them to make informative decisions. So we need to kind of perform a feature selection, or what we call the feature engineering process. This is to tell the machine learning models which indicators or which features make sense, so that we don't waste much of our computer power on predicting noises out of the black box. And yeah, so after that, we can get better understanding of the underlying process that generated the data. So there are different methods available right now. For example, the filtering methods, which is based on some statistical scores. So that's one method. And the second method is by some wrapper methods, especially, so this is basically a machine learning algorithm which you do as a preliminary step to filter out the less useful features or variables. And lastly, we have the embedded methods, for example, the lasso regression, or what we call the L1 regularization, which basically would go through all the feature variables and just shrink the coefficients of the variables that are not important. So shrink those coefficients to 0. And then after that, we have a number of useful features left behind. Then we can manage our computer power and also harness this machine learning process to make useful predictions. So this is a snapshot of the process. And Jay later on will show you the different projects. And yeah, so you will see the evidence and charts from the studies. And yeah, so I'm handing this back over to Jay.
Excellent. Thank you, Jean. And just to add to what Jean has mentioned, different models are deployed for different projects and different solutions. And in case of COVID-19 modeling, we had to do research of medical models or projecting medical scenarios. So we did a global research on models that have been applied in historic times, and we selected the model that is called Richard's growth model that was highly successful in predicting SARS virus, for example. So we were able to then utilize that model, build out the database and test the model, and then be able to project, and make some projections on the basis of that. So there's a lot of human insight that goes into the process, into a data science project that we take. As Jean said, it's always a good balance between art and science. With that note, I might move through to our evidence on the global pandemic. A couple of charts here. Really the key points to take away is you can see the data set does cover hundreds of countries around the world. I think it's about 130 countries. The left-hand side is really, the confirmed cases, and the right-hand side is active cases. A couple of points here. One, we present this data set in the context of growth rate. We don't, show you the levels. We show you the growth rate, which is a log growth rate you can see. And that is important because from a financial market perspective and from our client perspective, the financial markets were crashing and they were panicking because no one knew where the growth rates would go and at what level will it start to top out and so on and so forth. So we needed to focus on not what the levels of death and confirmed cases were, but what was the rate of change. And this framework, clearly shows here, with those, dashed lines is at what rate is the case doubling? Is it doubling every 2 days, 3 days, 5 days? So that framework was important because a lot of the medical, data that was coming out from medical fraternity was good, but it wasn't as relevant for the financial markets because financial markets needed to look at the rate of change so that they can price that in different companies, different sectors that were trading in public markets. So key point here, the other key point is that the diversity, if you like, the divergence of growth rates is quite significant. If you look at New Zealand, for example, is one of the successful countries that have flattened the curve pretty early. In fact, earlier than Australia, I must say. You can see New Zealand flattened its curve 20 days after the first 100 cases were discovered, and Australia subsequently followed, and so on and so forth. So that's makes our region in a reasonably solid position, solid footing. However, the worrying sign is that some of the largest economies and largest countries in the world are still seeing significant rates of growth. So for example, growth in cases. US, for example, the case, their curve has not flattened yet, and their cases are doubling every 4.5 days, for example, at the moment. If you look at countries like UK and Spain, they're a little bit more advanced and their curves are flattening. However, if you look at a large country like India, the growth rates are still reasonably high, and it's doubling every 6 days, for example. And as a result of that, you can see the global curve is at the moment, it's starting to slow down, but the rate of growth is still very high. And the cases are doubling every 6 to 7 days. While the countries in our part of the world and select countries like South Korea and others have taken action to curtail the growth, the global picture is still very worrying to us. And that means that this virus will be with us for a while. I'm going to move on to the next slide, which is I'm going to pass on the death rates because I think most people know, and there are different curves here. But I really wanted to share with you what our forecasting model has been showing. And in this chart here, I really show the Australian forecast. And what we predicted around, sort of end of March was that the Australian growth rate and the curve will flatten by end of April. And we've been updating this model every day. So yes, Australia has been successful, and the rate, peaked at around 6,500. And I think, there are certain, credits that we all can take, for playing our part. So that, that is interesting, in the sense that the economic damage that was imposed by the government lockdown have been successful in curtailing the problem, at least for now. Ultimately, the longer term problem solution is really finding a very good vaccine. And that remains some time away. And that's why from a market perspective and economic perspective, we continue to be concerned and continue to be cautious in our positioning and our advice to our clients. This one here is a New Zealand case. Our expectation was for the case to peak at around 1,500, and 90% of that was reached, slightly ahead of April end. And New Zealand has been really, pretty stable since that time. Currently, as of 3rd of March, almost 1,500 cases have been discovered, but the death rates have been very low as well. So a lot of the actions, I mean, in New Zealand, the lockdowns were level 4 in severity, and more significant and more strict than Australia, and clearly that has worked, which means that now the government is in a stronger position to relax some of these restrictions and get the economy back on track. And certainly the conversation between the two countries of the trans-Tasman bubble is very interesting. And I think, it is one that, is going to be very valuable for both countries. Globally, I'm conscious of time. Globally, we are concerned about US. Currently, our model is projecting that, the peak for US, unless we find a vaccine and use that effectively across the board, the US expected peak is 8.4 million, which will be sometime next year, around September next year. Currently, the cases that have been discovered in US is about 1.1 million. So there is a long way to go, but this curve can be changed, can be truncated by effective vaccine, and of course by effective shutdowns and so on and so forth. However, the economic damage in America has been very, very significant, which is a concern for everybody, because US is the largest economy in the world. Looking at the global projections, which I mentioned before, our expectation is for global cases to peak at 12.2 million sometime in September next year. 90% of the cases will reach, will be realized at that time, unless of course this curve is broken. So our key takeaway from the COVID analysis is that this virus is going to stay with us for a while. And while, actions have been taken, which has, flattened the curve in some countries better than others, until we find a solution, a permanent solution or a more effective solution such as vaccine, this virus is going to be with us for a while yet. So with that thought, I might just move through to economic update. And Jean sort of alluded to our framework of assessing global economies. And we are not an economic forecasting agency. Our job is not to forecast economy and sell that forecast to clients. We try to understand economies, and more importantly, the regimes that economies are operating under or likely to transition under, because that is a very valuable information for us to really position our clients' asset portfolios as well as investment selection. So that is the problem we are solving, is a asset allocation problem and an investment selection problem. And because markets and business cycles are intertwined with economic cycles, we really need to understand the economic backdrop and what regime are they operating under. And as we know, history tells us that economies go through the cycle of boom and bust. And at different parts of the cycle, there are certain attributes that resonate more in one particular regime versus another. So a lot of the data insights that we are bringing using the model that Jean outlined is designed to tell us where we are today, why we are where we are today, and more importantly, where we're likely to go. And in this, a crisis like this, which happens so quick, and with government coming in and shutting down economies, of course, everyone can say, yes, we're going to have a recession. And that's true. You don't need data science. You don't need foresight to tell you that. However, it is still important to understand which countries are facing what regimes, because not every country is affected in the same way. But right here, right now, our most concerning observation is that global economies are facing a recession, and that is causing inflation levels to go down. And given the structural imbalances of high debt levels across most advanced economies, the biggest risk that is facing global markets and policymakers is for economies to move into what they call is a deflationary bust regime, which is the most dangerous regime for investment markets and economies and policymakers. So as a result of that, we have seen, which is a very positive sign, that our policymakers around the world have been working overtime and in overdrive, rolling out policies to really reverse and mitigate some of the damage that has caused as a result of economic shutdowns and so on and so forth. So our view is that most economies will face recessions, and inflation will go down. Certainly, some of this is the global data set here at very high level. It really shows the GDP growth levels around the world, and the red is really showing that in 2020, a vast number of countries around the world will have negative GDP, which means they are facing some sort of recession. And certainly, I will show you New Zealand data in a minute, but that economic recession, economic contraction means that there is a drop in aggregate supply, but more importantly, a drop in aggregate demand that leads to excess capacity and price deflation and so on and so forth. Whether it's labor market prices, it's goods, tradable goods or services goods market. Destruction in demand leads to excess capacity leads to lower price inflation. And this chart is really giving you a global perspective on inflation. And what you can see is, vast number of countries and regions of the world had, inflation somewhere in the vicinity of 3% or less. So with this economic shock coming, chances are a number of these countries will see negative inflation or what's called deflation. And while deflation can be good for certain sectors and consumers and so on and so forth, it is not positive for the broader development of the economy, and it's certainly not positive if it goes out of control. And that is the reason why our central banks and policymakers have been responding very quickly and in an urgent fashion. Given that most of the countries are indebted, and if we have uncontrolled deflation, and weak economic growth, that can lead to spiral down in asset prices and what is called a debt deflation bust. And it's certainly no country in the world would like to see that, because coming out of that, depression-like state is extremely difficult. So hence the panic from the central banks, and hence the panic from global policymakers, that we have seen in this pandemic. This chart is really a time series of the growth rates across major economies. And I do have Australia and New Zealand there. But the point I wanted to make is that coming into the crisis, the economic growth rate around the world was below trend. So we were not booming. None of the countries around the world were booming. So the margin of safety for this kind of damage to the economy and so on and so forth is not very high. And that is one reason why central banks have put maximum policy effect into the system to counteract this. And sorry, important point, the projections from IMF and certainly our data shows that the result of the stimulus and some of the policy actions would be something like a V-shaped recovery. However, our internal view is that we are more like, the future is very uncertain. We don't know for sure what type of recovery we will see globally, but we think it's more likely to be a U-shape rather than a V-shape. But for a country like New Zealand could be slightly different, and Australia could be slightly different, but globally we think it's more likely to be a U-shape rather than a V-shape recovery that IMF is projecting, and simply because the dislocations as a result of this COVID pandemic is substantial, and various industries and employees and workers like yourself and us and businesses have to readjust, which means that things will not go back to normal anytime soon. And we also showed earlier that the global pandemic is going to be with us for a while. This is again here showing real GDP of New Zealand. And as I mentioned to you, we do look at short-term data, long-term data. The red line is really the longer-term perspective. And as you can see that the rate of growth is likely to roll over, and our view is that New Zealand economy will go into recession. Our indicators, particularly the leading indicators and surveys that are coming out of businesses and consumers, is suggesting something like a 10% total contraction in New Zealand GDP is highly likely by end of the year. Because of that excess capacity and destruction of demand, of course, some destruction of supply and dislocations, we expect the inflation rate in New Zealand to roll over. Coming into the crisis, in fact, the New Zealand inflation rates were going higher, particularly driven by services sector, insurance premiums, tourism costs, and so on and so forth. But our expectation and the leading indicators are telling us that the inflation rate will go lower from here. And over the medium term, we think inflation in New Zealand will be below trend rather than above trend. So with that, thought, I think, the key point to take away from the global economic perspective, and in particular for New Zealand, is that, the global economic backdrop is one of weakness. Global growth and price expectations will be below trend. And it is more likely that we will see a U-shaped recovery rather than V-shaped recovery. So turning to markets, what have the markets been telling us? Of course, the rapid situation and the rapid development and spread of pandemic over the March quarter or March month led to significant damage across financial markets. Many of the equity markets around the world crashed in that period, some of them losing as much as 50%. Global equities, in US dollar terms, lost about 40%. Australian shares lost about 40%. New Zealand shares lost about 25-30%. So the destruction was significant. Bear market was observed around the world. And while we have seen, this chart shows the three performance of major asset markets in Australian dollars. And what you can see there is the market crash during that March period, and then subsequent rise or recovery of the markets. While the recovery was really triggered by the central bank actions and government actions around the world, and in particular, the US Federal Reserve Bank saying whatever it takes, and they unleashed multi-trillion-dollar policy initiatives to counteract the damage of COVID. So markets have reacted, but we are very skeptical. We call this market recovery in equity markets in particular a bear market recovery, and we are very cautious in terms of the outlook for markets, given that what we said was the COVID is going to be around with us for a while, and economic backdrop is not positive. This chart here is really showing a similar pattern, of the earlier chart, but for New Zealand market. As you can see, the market in New Zealand, in particular equity markets, crashed quite substantially, but followed by a very swift recovery in the month of April. And that swift recovery, really has been quite aggressive in New Zealand, more so than perhaps in Australia and US. And what's driving that is really, global investors wanting to take advantage of some of the vicious sell-off that occurred and so on and so forth. And with the New Zealand market being a thinner market from liquidity perspective, small amounts of capital can lead to significant changes in prices, both up and down. Of course, not all sectors have been similarly affected. This chart here shows, different sectors of the New Zealand stock market. The key point to note here is that, the sectors that are most exposed to the domestic New Zealand economy on the back of the kind of expectations on GDP growth, inflation growth, and dislocations, you can see those industries have been most affected. So for example, these here. So for example, the consumer discretionary sector, over that crisis period, which we show on the right-hand side, from the 21st of February, when the crisis started to spread across the globe, through to the bottom point of market on 23rd of March, the discretionary companies, consumer discretionary companies in New Zealand went down, for example, 61%, followed by IT, industrials and financial companies, all down, more than 40%. Now you can see on the left-hand side, over the month of April, a recovery has followed, but those levels are well below the peak that we saw coming into the crisis. So yes, the hardest hit sectors have recovered most. For example, discretionary at 30%. But if you look at sectors that are most resilient to economic slowdown, such as staples and communication, they didn't fall as much, but the recovery also has been reasonably modest. So that's sort of the market impact has been substantial. In the interest of time, I'm going to skip through this slide. I really wanted to show some of the work we have done using data science and other factor work that we do at, in our business. We have been looking at, companies and different factors that drive, equity markets and bond markets and so on and so forth. Here, I'm just showing you the evidence on equity market. And what we are showing you is a global, global markets, comprises of about 10,000 companies that we model every month. And what this chart is showing, and we're really trying to show in the times of market crisis, in times of economic crisis, or the regime that we are predicting, what type of companies really thrive in this environment. And what we show is some of those periods like SARS in 2002, we show the global financial crisis, European debt crisis, and then we show you the COVID crisis, which is up to March quarter for COVID. So the first really 30 to 40 days of that COVID crisis. So the message that comes out from our analysis is that there are certain type of companies that are clear winners today and are likely to be clear winners in the future, given the market backdrop. But there are other types of companies that will be very clear winners. So our recommendations to clients is to focus on those companies that are likely to be the winners. And those certain attributes or types of companies that are likely to be winners are those that are high quality companies, that have resilient business models and they have very strong balance sheet. The other attribute is companies that have digital assets. we've seen, you know, companies that have massive, you know, hard assets such as real estate, such as, you know, shopping centers and so on and so forth have been hit really hard. But on the other hand, companies like Microsoft, like Amazon, like Google, you know, like A2 Milk, for example, it's slightly different business model there, but those companies have actually benefited. And you can see that, you know, the black line for companies with digital assets, the black line is going up in this crisis, which means these companies are outperforming, which means investors are putting money into those companies. The other thing, you know, to watch is companies that have growth, that are insensitive to economic environment. What we call is idiosyncratic growth, or growth that is driven by intellectual property or some sort of, you know, business model advantage. And those companies that are growing faster than the average companies and have more resilient growth trajectory are outperforming companies that are highly cyclical and exposed to economic data. So our message is to, you know, that there will be losers and winners. Focus on high quality companies that are large cap and that are highly liquid and are growing faster and are highly resilient to economic environment, you know, that we are anticipating. You know, so with that, you know, sort of thought on markets, there's so much more I can show and Jean and I can share. But in the interest of time, you know, this is sort of been our high level, you know, presentation. And I think three major points I would like everyone to take away is: number one, pandemic is not over. It's going to stay with us for a while. Number two, that the global economic backdrop is negative, and caution is warranted, given that a lot of the advanced and largest economies in the world have structural imbalances such as high growth and high unemployment, and less resilient economic structures, which means that we are more likely to see a U, and with some risk of even W or L for certain economies, we're more likely to see a U rather than a V, as IMF is saying. And lastly, there will be winners and losers from investment market perspective. You know, it is the time when you can use evidence-based framework in a very, you know, in a rational framework to really understand which types of companies will be winners around the world, will be winners in New Zealand, will be winners in Australia, and focus on those companies. And our work shows that it's really the large, liquid, high quality, growing companies that are going to be the winners in the environment that we anticipate going forward. So with that note, I will pause there, and I know I'm running late, but it's a nice segue for us to take questions from the audience.
Thank you very much, Jai. And we all join you in a virtual applause for you and Tian for taking us through some very significant insights with regards to where the market is navigating at the moment. Can I just start off with a questioning to yourself? In hindsight, is there anything you have learned in the recent past that could have alerted us of the seismic events that were about to unfold?
Yeah, that's a great question. In hindsight, yes, hindsight is a great benefit. What, you know, we have observed studying crises and different economic regimes around the world is that every crisis is different and is unique. This crisis is unique more so than others because it is a health crisis that transmitted into economic and financial crisis. So a lot of the tools that we would have used in traditional, you know, analysis, if you like, during the global financial crisis, needed to be re-looked at. And that's why we had to pivot our work towards understanding the growth rate of COVID and so on and so forth. So in hindsight, if there's something we could have done better, is really pay attention to leading indicators, and in particular, stock markets are a great leading indicator. And when stock markets were reacting negatively and in US and the fear gauges were going up, one thing that a lot of people could have done or we could have done better is go to cash, go to defense very, very quickly.
Thanks, Jay. Sally, can I just ask you to just go to the Slido platform and see the questions from there, please?
Yep, sure. So the first question I have is, isn't rationality thrown out of the window in the current environment, and that fear actually rules now?
Yeah, that's a good question. And yes, in times of a rapid crisis like this, that is so widespread and it affects humanity at the core, it is completely understandable that people are emotional and they are taking actions from their emotional mind and their emotional state. So yes, however, we need to balance that emotion with objectivity, with rationality. And I tell you, the policymakers around the world have really balanced that quite well, particularly if you look at in Australia and New Zealand, where some of the things were complete no-nos 3 months before became yes, yes, because our politicians were balancing between, lives and livelihoods. And as a result of that, they took aggressive actions. So yes, emotional element is a big driver, but I would say to people, if you are making decisions that are high impact and going to have lasting effect on your livelihood or your life, then you need some sort of balance between rationality and emotion.
Okay.
And one thing I would like to add is while this market is going crazy and everybody is in fear or very emotional, and we could lean back and kind of use the cool head in terms of data science and all the data analytics to help us and guide us through this very stressful situation, and hopefully come through the tunnel and seeing the light at the end of the tunnel.
Okay. All right, the next question. How do you go about deploying and maintaining trained models on the customer side? And what formats and systems does that involve?
So
Take that.
in terms of the trained model, it would be useful to have something that's very stable. And once you are happy with the stable results, and then that's the model to go to. But if you look at your model and see that your model is unwieldy and any new data would impact the model prediction significantly, that's something not going well. And that's probably the time to go back to relook at your parameters in your model, and as well as seeing what kind of features that have impacted on your model. For example, did you have some new signals coming in that you haven't taken into account before? So yeah, that's my take on that question.
Right. And just to add to that, for example, our economic regime model that lead to asset allocation indicators and so on and so forth, we needed to adapt our information set and our data set to account for COVID situation, because that was the causal driver of all economic and financial malaise that we saw. So adaptability is key, as Jean said. In terms of how we manage some of these deliverables for clients, we do provide a managed service. We are a modern business built on modern foundation. So we are cloud-based. We are able to pivot our solutions and our models so that our clients can use those even if their staff and employees are at home, as long as they have internet. So that cloud model, adaptability, and using robotic processes to manage large scalable data sets has really stood us in a very strong and in a resilient framework, if you like, with clients.
Thanks, Rajay. Sally, one more last question, please.
Okay, sure. So how relevant is the previous pandemic actual prediction and its use to predict the future with regards to COVID-19?
I assume what you mean by previous pandemic is not the Spanish pandemic in the past.
So Ebola, SARS, or MERS?
Right. Yeah, actually, there are some commonalities between the SARS and the Spanish flus and all that in terms of the model construction. And it's the model bases are very similar. It's just that this time we have a very uncertain aspects coming in from different angles, and no one knows what the final pandemic size will be. So this time we have a bigger uncertainty in terms of feeding the features into the model. But overall, we need to do what we have been given using the limited data that's available, and different countries, as you can see, the models work quite well on different countries, and in that respect, we have quite a lot of data available, so that helped us from that end.
Sure. And just to add to that, yes, you know, the model that we adopted, so we did a search on prediction models around the world, and there are thousands of models, as Jean said. But we settled on a model that's called, that was, you know, that came out of a paper by F.J. Richards titled "A Flexible Growth Function for Empirical Use," that was published in Journal of Experimental Botany. And it was published in 1959. You know, so that particular paper was referred in other models that were used or other people had used for SARS and so on and so forth. And that particular model was particularly very successful in predicting SARS virus. So out of all these models, we used Richard's growth model, which utilizes a generalized linear regression and generalized regression framework, as Jean mentioned. You know, so there's no right or wrong answer. Yes, there are uncertainties around, you know, prediction of any sort, particularly one that has, you know, limited current case data, if you like. But the fact that, you know, we were able to identify something that was utilized live in SARS and was subsequently tested to be very good, we were able to deploy that against a global data set. Currently, we predict on a daily basis, you know, growth rates across the largest economies, you know, about 20 economies in the world, and it includes emerging economies such as China, India, and so on and so forth. You know, so the data set, you know, is widely available, which is brilliant. 10 years ago, you know, I would imagine it was very difficult, and certainly in 1959, when this paper was published, you know, by Richards, certainly the availability of data would have been much more limited. But yet that particular technique proved very relevant for any crisis of this type, and certainly for SARS and for COVID-19.
Well, thank you very much, Jai. And I think if there ever was a domain that was built for a problem, it has to be data and data ops at this time, in a period where we are facing a global pandemic. And this is a moment for your domain and for yourselves to rise. And I think we're very privileged to have heard yourselves from Australia. As we look at closing the bubble between Australia and New Zealand, our politicians are trying to do that busily. No doubt that decision is anchored in some kind of predictive analysis that has been done using data. Well, at least we hope so, because we don't want your virus here as much as you don't want ours there. So thank you so much once again. I know there were several other questions, forecast questions on the chat room as well. What the data ops team will do is get answers for you for those questions as well, and we'll share that through this platform. I recognize particularly yourselves finding time midweek to be with us instead of with family, so we really appreciate that. Thank you again, Jai Tien, for your input and preparing for your views and insights into what is an exciting and interesting topic at this time. We acknowledge specifically the sponsors again, Potentia, who have forefronted this to assist in getting this domain mainstreamed. Our team will be in touch with yourselves for feedback survey as well. That is aimed at helping us to assist in getting these platforms and the way we present these in the future in a better way. So thank you once again, guys, and we look forward to the next session. Thank you so much.
Thank you, everyone. Thank you.
Thank you.
Sure.
Thank you.
Bye.